I'm Dawson Schmidt here with the latest stories and developments in this week's Commodity Roundup on Trader PhD. China is finally confirmed to have purchased U.S. soybeans after the USDA resumed its reporting after the government shutdown ended. As of Thursday, China is confirmed to have bought about 1.82 million metric tons of U.S. soybeans, according to recent flash sales data. So far, confirmed sales accounted for about 15% of the 12 million metric tons the Trump administration said China would buy by January 1st. Media reports do suggest that total purchases are over 2 million metric tons. Seasonal data shows that China would be purchasing U.S. soybeans outside of the typical window, which could question its ability to meet the quota while the White House has promised. Additionally, U.S. premiums over Brazilian soybean prices could also disincentivize Chinese importers from looking for U.S. supplies. Biofuel producers and ag groups are waiting on highly anticipated biofuel blending mandates from the EPA. Ahead of a key announcement, rumors floated that the final rule may not be as favorable as initial expectations. Reuters reported on Wednesday that the Environmental Protection Agency could delay implementing a provision that could cut the value of fuel credits for imported feedstocks. Under the proposed rule, imported feedstocks used in domestic biofuel production would receive half of a tax credit rather than a full credit allotted for domestically sourced feedstocks. The EPA was initially set to release its final rule for 2026 and 2027 renewable volume obligations on November 1st. The current proposal is expected to lift demand for biomass-based diesel, benefiting feedstocks such as soybean oil. U.S. fertilizer availability could see some reprieve after the Trump administration announced reduced tariffs on some commodities. The fact sheet released by the administration last week says certain qualifying agricultural products will no longer be subject to those tariffs, such as certain food not grown in the United States, and that exclusion did extend to fertilizers. Josh Linville, Vice President of Fertilizer at StoneX, says that while the reduced tariffs could help, the move does not offer a large fix on the retail level.
It helped remove a barrier. It made it a little easier to make the decisions, but ultimately speaking, it's going to be a small move. It's not going to be massive.
Linville says factors affecting fertilizer prices, specifically nitrogen, are global. Eyes are still on China's urea exports after a deadline expired last month for opening the export pipeline. However, Linville says more tonnage could still reach the global market.
However, last week the word is that China is going to allow another 600,000 tons to be exported above and beyond the October 15th date. And the rumor mill is they could actually double that. They could jump up to 1.2 million if they start looking through domestic supplies and prices and they come to the conclusion that, yeah, we can let these tons be exported and we'll be okay.
While exportable supplies could help alleviate high prices, India's latest urea tender is expected to be bullish for the global market. The country recently issued a tender to buy 2.5 million tons of urea, which was much higher than the 1.5 million tons anticipated by analysts. Linville says the scenario could shape out to be a bullish event. Thanks for watching. I'm Dawson Schmidt, and this has been Trader PhD.